The paper is joint with Stephen from Zurich, Jörg from Berlin, and Wahid, who is now in Madrid. This doesn't work. Hold on. Now. So, as Bruno already said, this paper is about the long-run effects of financial crisis. Now, you all know this, and I don't need to emphasize that much, but of course we know a lot about the short-run effects of financial crisis. So what happens in the crisis? There is effects on investment, employment, growth, etc. But at least from my reading of the literature, we know relatively little about the long-run effects. Now, that may have to do with that in order to look at the long-run effects, time has to expire. And so partially, I guess, we will be, I'm sure this paper will be part of a bigger group of papers that will look at these things. So one thing that we are trying to start to think about is whether financial crises have persistent effects or even permanent effects. Permanent is a very big word, so persistence is better. And in this paper, more specifically, we are interested in the interrelation between these long-run effects and how the government intervened in the crisis, right? So as Bruno pointed out, so was there a lot of forbearance in the crisis? Or were the supervisors very tough with the banks, resolved non-performing assets, restructured the banks, etc.? So this is sort of the decision we're looking at, and we're trying to see, so there's a financial crisis, the supervisor reacts, either tough or not tough, and then we're looking at down the road, 5 years down the road, what do we see? Is there a difference? Okay. Now we are going to be interested in particular in productivity. And now we're not actually going to estimate productivity directly, we're just going to look at lots of proxies that have been used in the literature for productivity. And there is, while there's no literature on the effect of financial crises on productivity, there is quite a literature on the effect of recessions on productivity, right? And if you want, there are two views on this. I mean, Haltiwanger and many co-authors has argued that recessions can be good, so in a cleansing sense, in our sense, in a way that there's a low opportunity cost for doing overdue restructuring activities in firms. That's sort of the main argument of a whole series of papers. I'm just citing one here, but there's many papers that sort of argue these types of things, that in a recession, this is the time to change things because the opportunity cost is relatively low to change things. And that then has ultimately positive effects in the long run, or may ultimately have positive effects in the long run. But of course, Anil Kashyap and Caballero have argued the opposite in a way. They've said, in particular, in financial crisis, this may be a problem for productivity growth because of these financial frictions. Financial frictions become much more severe, and hence there is sort of this slowdown effect on productivity. Okay. So we're sort of adding to this debate by asking, well, does it matter how you deal with the financial instability? Are you forbearing or not? Now, let me try to convince you of this sort of mechanism by which cleansing takes place that we have in mind. Now, there's some literature on why banks may keep lending to non-viable firms, right? and in this literature, this is called sticky, inefficient lending relationships. For example, De Watrepont and Maskin have a paper in now relatively old, in 95, where they argue that in the presence of sunk costs and asymmetric information, it may be optimal for a bank to keep lending to a firm that's actually not viable. Or Caballero has a paper where he argues that if there are soft budget constraints, like public guarantees, for example, or other soft budget constraints, then it may again be optimal for the bank to keep lending to firms that should not receive credit. I have a paper, and Bruno mentioned it already, where we show that public guarantees may act much like this soft budget constraint story and result in an inefficient allocation of capital, and poor firms, non-viable firms, may be much more likely to be able to obtain credit if there are public guarantees for banks than if there are no public guarantees for banks. And we use the same experiment for this paper that we used in the other paper that you mentioned, where we look at the risk-taking of the banks. And then I would like to add sort of a fourth point, which is a little bit more ad hoc. It's not based on a formal model. Certainly, we haven't done a formal model. And that is, suppose you are a marginal bank, just above the capital requirement. If you realize losses that stem from these non-viable borrowers, then you may just fall below that threshold, the regulatory threshold. And if you fall below the regulatory threshold, then the supervisor is going to show up at your doorstep and tell you what to do, right? And in order to avoid that, you may want to just keep lending to these firms and hope for some miracle that these firms recover in the future rather than realize the losses. So the evergreening is a typical practice to keep firms from dying that should be dying because the bank doesn't want them to die because they don't want to realize the loss right now. Typical, I would say some of this is going on in Italy or has been going on in Italy for quite some time. Now, suppose there are these sticky, inefficient lending relationships, they will distort competition, right? Because if you keep firms alive that are not viable, that's essentially like an implicit subsidy to these firms. And it may keep other firms or new firms from being able to enter the market, or at least it makes it more difficult for new firms to enter the market. So the market share of unproductive firms is too high. Now, we're not going to look at that in this paper, but in a welfare sense, it's too high relative to what it otherwise would be. Or it's not declining rapidly enough, as one would hope if the allocation of capital is efficient, right? You would want that the capital flows to these new, more productive firms away from the old, unviable firms, and ultimately this is going to result in lower productivity growth. Now, further, of course, these sticky, inefficient lending relationships and the unwillingness of banks to realize losses may depress credit supply. This is a lot of people are talking about this in the context of Italy, that just these legacy assets are sort of keeping banks from extending new loans to new viable borrowers because they have to sort of keep their customers that are not viable alive. Now, suppose, and we don't take a position really here in this paper on which mechanism exactly is at work, but suppose what a financial crisis does, or one way to look at a financial crisis is that it will push these marginal banks over the edge. It will eliminate a lot of these inefficient, sticky lending relationships because these banks just go under, okay? And hence, a financial crisis through facilitating the restructuring of weak banks, through resolving non-performing loans and cutting these non-viable firms off from credit by eliminating evergreening, may facilitate an efficient reallocation of resources, which ultimately then is going to result in higher productivity growth. That's sort of the basic cleansing effect that we mean. Okay, that's what we mean by cleansing. Hence, in a Schumpeter sense, a financial crisis may foster creative destruction. Yeah? New entry, more efficient allocation of capital, hence higher productivity. That's sort of our basic story that we have in mind in this paper. Now, the extent to which the financial crisis will actually facilitate this mechanism depends on the intervention of the supervisor in the crisis, right? If the supervisor is very forbearing and keeps these banks operating essentially without major intervention, without a resolution of failing assets, without a restructuring of the financial institution, then we would expect, based on this mechanism, there to be relatively little cleansing. Whereas if the supervisor is very tough and closes down the banks, sort of the Darwinism that Bruno was talking about, if he's very Darwinistic, then we would expect a lot more of this cleansing effect to be able to become operational in order to facilitate productivity growth down the road. So if you let the fire rage in the woods a little bit longer, more dead wood goes out, and hence more fresh trees can grow. We don't use this metaphor in our paper, but I like it actually. We should maybe put it in. So then in this paper, what we're trying to do is to test the relationship between the degree of forbearance during the crisis with productivity or allocative efficiency after the crisis. So this sort of correlation is what we are interested in. Okay, so how do we do that? Sorry, it's very warm here. So we do that using US data. Now, I should say that when we started out with this project, we actually had more Italy and Spain in mind. And we thought about writing a paper using data from European countries, but it's just much more difficult. I mean, we simply didn't get the data. We don't have comparable supervisory environments. There's lots of issues. So for the time being, we're just looking at the US, and we're looking at US metropolitan statistical area. So the unit of observation ultimately in our regressions is an MSA. Okay. So whether in an MSA, the regulator or the supervisor was more forbearing or less forbearing, and I will spend a lot of time on trying to convince you that there's actually something there. And then so we trying to use this exogenous variation, and I will also spend a lot of time on the extent to which this is exogenous. We're going to instrument it, but still, we're going to use this exogenous variation in the degree of forbearance in a local market to look at the long-run consequences. And we're going to use lots of, as I mentioned already, lots of standard measures of productivity, including wage growth, patterns, per capita growth, firm entry and exit, et cetera, et cetera. So we're going to have for each, sort of for our baseline results, we're just going to have a whole bunch of indicators, and it turns out the results are consistent across all these indicators. So it doesn't really matter which one you look at. And then the baseline core result is going to come out of a regression where we look at the relationship between forbearance during 2007, 2010, so during the crisis, on post-crisis outcomes in terms of these productivity measures. So in case you have to leave, so let me give you the three main takeaways. One, forbearance works. What do I mean by that? Well, forbearance works in a sense that output losses, job losses, firm closures are fewer in a crisis if you're more forbearing. Now, that's sort of good news. If we didn't find that, I would be very worried, but that's what we find. So in other words, forbearance from the perspective of the moment in the crisis makes sense. I mean, it's not, it reduces the real effects of financial disruption. However, it is also very negatively, and I think I can say that, very negatively correlated with the output productivity growth indicators that I just listed before after the crisis. And after the crisis, in our case, is 2011 to 2015. So these 5 years after the crisis. So the bottom line of this paper is tough policies during the crisis yield higher payoff afterwards in many different ways. Many different ways. Now, of course, you will immediately say, and I'll come back to that, the political economy of this is a disaster, right? I mean, it means that the supervisor has to trade off short-run loss for long-term gain, which politicians are never good at, not just in Italy. I mean, they're never good at that anywhere. Let me briefly give you a little bit of a survey on the literature. As I mentioned, there's lots of literature on the sort of the in-crisis effects on the real economy. There's papers on lending, on investment, on consumption, on employment, but very little evidence on the long-run effects. Now, there's Carlo Wicks, who's now at the board. He has a paper on a story that relates labor regulation to long-run effects. So he looks at firms that are affected more in a crisis and then looks at their recovery path. So do they ever catch up? So suppose your competitor was not affected by, or not as much affected by the crisis. You were affected by the crisis. So you will reduce your investment more. That's the typical identification scheme that Schroeder-Reich, for example, uses. But then what happens later? I mean, do you catch up, or is there a permanent distance, etc.? And he shows that whether or not there is a permanent effect depends on whether the firm is able to do labor hoarding or not. That's at least important determinant. So it's very important whether you keep your staff or whether you actually fire a lot of people and then have to rehire them. These rehiring costs seem to be very expensive. But that is, in my view, from what I know, to my knowledge, the only paper that looks at this. Now, there's also, and we're going to have to say quite a bit on this, literature on the effects of bank recapitalization, and there are a little bit different views here. There's a paper by Homer and van Winbergen that argues that if you recapitalize banks, like in TARP, sort of forced recapitalization, you eliminate the problem that we're talking about here. I mean, they don't look at firms, but you eliminate zombie banks. So at least banks that are very marginal, etc. You eliminate them because you give them the capital and then they become better. Now, Ashaya has a paper where he says it's not true. He shows the opposite. He says, well, if you recapitalize banks, it doesn't solve this problem. And sort of the I don't know, the consensus view maybe is a paper by Guido Tabellini, who says, well, yeah, but the effects are small. And you will see, we're going to look at, in this paper, we're going to compare the effect of forbearance to the effect of forced recapitalization. And we will see that they're different things. They have different effects, okay? So bear with me, is quite a ways until we're there, but so we're going to have to say something about this literature as well. And there's very little on resource reallocation. I mean, ultimately our paper is about resource reallocation, but there is a paper by Mukherjee and Probsting, and they argue that sort of crises are cleaning, in a sense that they're cleaning the market for corporate control by intensifying mergers and acquisitions. So there's more mergers and acquisitions. It's related, it's a sort of a very different perspective, much more finance perspective than we're taking. We're taking much more of a sort of macro productivity perspective on the topic. Okay, so we use a lot of data for this, as you can imagine. So we use census data for the number of firms, establishments, entries and exits, job creation and destruction, which we can get at the level of the US MSA. We also have annual wage growth, which we take from the quarterly census of employment and wages, and we also take GDP and GDP per capita growth at the MSA level from the Bureau of Economic Analysis. We also use patent data from the US Patent and Trademark Office, and we also use bank data where we use SNL, the SNL database. So we have all FDIC insured commercial banks from 2000 to 2015. And we also, of course, need a sort of this, whether a bank was restructured or not. So we use the FDIC list of restructured banks during the crisis. And we also need branch office deposits for a very small part of the paper. I may not even talk about it much. I only have one slide at the very end on this. This is on, well, suppose you have a really tough regulator or a really forbearing regulator in your MSA, but you have branches in another MSA. So what do? I mean, how does this affect the other MSA? And we show that actually it affects the other MSA in a tough way because you're forbearing. So in some sense, in order to repay the supervisor for his favor, you sort of shift assets towards your home base where you're supervised. So we can show some of these effects, but that's not at the core of the paper. Now, the bank level data is actually 2000 to 2015. So we have 3 sub-periods. We have the pre-crisis period. The crisis period we define as 2007 to 2010, and then the post-crisis period. Ultimately, we have about 45,000 bank year observations, 5,200 unique banks, of which, by the way, about 7% failed. And we have a distribution of supervisors. So we have majority with the FDIC. We have 14% Fed, 20% OCC, and 80% of our banks are state chartered. So we're looking at small banks, right? So this is really a small bank story because we can't allocate Bank of America to an MSA. I mean, it doesn't really work. So we're looking at small regional banks here. Here are some descriptive statistics on the bank level sample. Nothing really exciting here, so let me just skip over that. The MSA level, ultimately we're going to have 262 observations, so 262 MSAs. And it's going to be a cross-section, so it's a very low-tech paper. I mean, it's a cross-sectional regression with an IV, that's it. So we're not doing anything fancy here. This may be a little bit more interesting. Ignore so this is the MSA level data set. So ignore the top 2 lines because I haven't talked about them. But the next part here, can I point? Yeah. So the next part here is in the crisis. So what happens in the crisis? And you see that about 10% of establishments, so these are plants, exit or closed. About 7.5% firms close in the crisis on average. 14% of the jobs disappear. And if you break that down, how many of the jobs disappear because the firm closed? That's about 4%. Or how many of the firms disappeared because the firm just shed labor? That's 10%. So the composition of 14% is 10% of continuing firms is just fired people, and 4% of people who were with a firm that closed down. And then if you look at the next panel here, that's after the crisis, so post-crisis. And we find that there's 9% new plants opening, 7% new firms entering, 13% new jobs, et cetera, et cetera. So now overall the numbers look pretty reasonable. So they look like they make some sense. So in order to do this, the first step is to come up with a measure of forbearance, right? So that's sort of crucial. So I have to convince you that our measure of forbearance makes sense. And forbearance is a little bit of a, it's not exactly a very tangible thing. So we have to come up with a way to estimate that. So what we're doing is we're essentially using an approach by Wheelock and Wilson. They didn't try to estimate forbearance, but what they try to estimate is essentially sort of a bank failure or bank restructuring prediction model. And in the way they argue is, well, let's use sort of CAMEL ratings, so capital assets management, what's the E stand for? I always forget, and liquidity. and use proxies for that. And we do the same thing. So we have equity in there. We have loans, real estate, commercial lending, non-performing assets, return on equity, liquidity, efficiency, etc. So it's standard camel variables. We've supplemented by, because we're looking at this at the MSA level ultimately, so we look at local output growth in that MSA, and we look at the industry mix in the MSA. So just sort of an industrial structure variable. And now we're not really interested in this regression, but I show you the results anyway. So this is what it looks like. So if you go through the different variables, most of it is pretty reasonable. It's certainly very consistent with what Wheeler and Wheelock did. So we're getting essentially very similar results out. More profitable firms are less likely to fail, etc. That type of thing. More firms, banks with more equity are less likely to fail, and so forth. Now, what we're interested in is regulatory forbearance. So what we're doing is we're using the residuals from this regression. So what's unexplained by objectively observable characteristics of the bank. And then we calculate, using these residuals, the bank size weighted average in each MSA, so how big the bank is within that MSA, and we calculate a weighted average, weighted by bank size, of this residual for each MSA. And then we average over 2007 to 2010, so over the crisis period, to obtain a cross-sectional measure of regulatory forbearance in the MSA. That's what we do, okay? This is clear, it's very important. So this is our central variable, so it's important that you understand what it is that we're doing. So we regress these sort of prediction regressions on whether or not a bank was restructured or not, take the residual and aggregate it at the MSA level. Now, given that this is sort of a very flaky measure, we spend a lot of time on checking, well, I mean, does our measure exhibit the characteristics that other people have found regarding forbearance? So we could find 4 papers that look at this. It's not many, but if you have other papers that look at this, I'd be very curious to see them. And the first is a paper by Agarwal, Luca, Zero, and Trebbi from 2014, and they show that state-chartered banks benefit more from regulatory forbearance than federally chartered banks. Now that makes some sense. I mean, the shirt is closer than the pants, as I say in German. So you want to. The state guy is more interested in keeping the bank open than the federal guy. Now, this is the distribution of our measure. And the solid blue line are state-chartered banks, and the dotted red line are federally chartered banks. And you'd see that we have a little bit more mass over here to the right, so there's more forbearance based on our measure for state-chartered banks than for federally chartered banks. So in that sense, we can confirm their results. So in this sense, our measure seems to confirm expectations. Oops, wrong way. The second thing that people have found about forbearance is that in markets with more competition, there is less regulatory forbearance. There's a paper by Kang, Lowry, and Wardlaw from 2014. So we checked that for our measure. So we ran a simple regression forbearance on the number of banks in the MSA, and we find a nice negative and significant relationship. So our measure seems to also be weaker in markets where lots of banks are operating at a very basic level. The third point that Adam Ashcraft has found is, and don't ask me too detailed what exactly a cross-guarantee provision is, but he finds that cross-guarantee provisions facilitate the restructuring of subsidiaries relative to independent banks. Okay, so we could check that as well. So we check that, and we find that. So we find if there are more subsidiaries of other banks in an MSA, there is less forbearance. So that's consistent with Adam Ashcraft's result. And the final thing that we wanted to check was whether there was persistence in this measure. So in other words, we wanted to see whether MSAs were always more forbearing than some MSAs were always more forbearing than others, because if they're not, then there's no systematic variation that we can exploit. Now we find a lot of persistence. So this shows you the level of forbearance split up in quartiles. So the first quartile is those MSAs with the highest level of forbearance in 2007, and that's the what is this yellow line at the top, and the blue line at the bottom is those MSAs with the least amount of forbearance based on our measure in 2007, and we see that there's relatively little crossing here, right? That's what we want. So that we want that if an MSA is forbearing, it's always more forbearing and not just sometimes. So that's important for us. So we do find a level of persistence in our measure of forbearance, and taken together with the other 3 points from the literature, what properties forbearance should have, we would say, okay, what we're measuring makes some sense. It does seem to have something to do with how forbearance was analyzed in the previous literature. Okay. Now, we have a little bit of a problem in a sense that perhaps there is a correlation between regulatory forbearance and the expectation of local authorities about future economic developments, right? So I've cited this paper where the Agarwal, Luca, Zero, and Trebi paper. They show that supervisors may be more forbearing if local expectations about growth are really bad. Now, that's a problem, right? I mean, if we then ultimately find this forbearance and this lower productivity growth later, that's not good. So we have to address this issue. And the way we do that is that we instrument for forbearance. So remember, we have this calculated measure of forbearance, and we instrument for it. And we need an instrument, obviously, that's correlated with regulatory forbearance, but not correlated with growth or productivity or whatever. Okay. Now, that's a little bit difficult. It wasn't an easy task. Now, what we're going to use is the distance to DC. Okay. Now, as you will see, it works well, but let's ignore that and let me try to give you actually some economic arguments for it, why it should work well. And there are a number of economic arguments. One is that just distance is just a good proxy for information asymmetries. That's a classic paper by Hans and Steven, that the further you are away physically, the less information you have, so it's easier for the bank to fool the supervisor, right? That's one way to think about this. But more specifically related to this measure, Lambert shows that distance to DC affects banks' ability to lobby. Now, that's very closely related to our story, because if you're not as able to lobby, there may be less forbearance, right? So lobbying, you may in fact lobby, then ultimately receive forbearance. So that's good news for us. So that's a nice argument that justifies the use of distance to DC. Dam and Kötter, my colleague at the Institute, he has a paper in the AFS where he shows that the political influence on banks and presumably also the political benefit of banks decreases with distance. Okay? So that's again sort of an argument related to forbearance where they do this for Germany, but where sort of this political link between banks and regulators, which may be beneficial in terms of forbearance, is weaker depending on your distance. And then a final argument, again from this work by Zero and Trebi, shows that distance matters for the revolving door story. So there's this story that supervisors are more forbearing because they want a job, a high-paying job in a bank. And so, but this revolving door story is more difficult if the bank is just geographically further away. I mean, if you can have lunch with the banker every day, then the revolving door is just more likely than if you are 1,000 miles away. So based on all these arguments, we're using the distance from DC. That's our instrument. And now, of course, we still need to spend a second on the exclusion restriction here. Is the exclusion restriction actually satisfied? Because we do need that the distance to DC is not somehow a driver for productivity. But if you think about it, you will realize that it could be. Unfortunately, it could be. Why? Because if you are closer to DC, you may be, based on essentially the same argument, more likely to receive subsidies or some sort of beneficial infrastructure investment or what have you. And if these things are actually good investments, they would increase productivity. Now, the nice thing is that it works the opposite direction from our story. Okay, so we're ignoring this problem. There is an issue here, but it goes the opposite direction. So if anything, it should reduce our results. It should bias our results down. How much time do I actually have? I have 15 more minutes. Yes. That's very bad. Do you talk too long at the beginning? I must have much more than 15. All right, so let me show you the first stage. So this is our first stage of the IB. So distance is nicely, significantly related to our measure of forbearance. So the further away from DC, the less forbearance. That's what we find. Now, our F-test here of excluded instruments is, F-test statistic is 7. Now, there's sort of this rule of thumb, you want to have a 10. But quite frankly, I've never written a paper in which I had a 10. So I don't know. It's a pretty good instrument. It's not perfect. We do a whole battery. If you look on the paper, we do a whole bunch of tests. We really take out the instrumentarium of econometrics here to test this instrument, and we have no evidence that it's not a good instrument. So it seems to work. Now, with this measure of forbearance in hand, we check many things, but primarily we check, does this measure have an effect on outcomes during the crisis? And then, does this measure have an effect on outcomes 5 years down the road? Okay. So let's look at first the real outcomes during the crisis. So does forbearance have an effect on outcomes during the crisis? So why here are variables, outcome variables in 2007 and 2010, so during the crisis, and regress it on forbearance in the crisis. So these is a contemporaneous regression, one on the other. And again, it's at the MSA level, so we look at average MSA level establishment and firm exit rate, job destruction, etc. And again, remember, X here is instrumented by the distance to DC. So obviously, the log distance plus 1. So what do we find? So these are different outcome variables. This is the establishment exit rate. We have the firm exit rate, job destruction by firm exit, and job destruction within firms that continue to exist. And you see there's a strong negative. All the forbearance coefficient, forbearance enters every time negatively and very significantly, meaning that if there's more forbearance, there's less job destruction, less firm exit, less establishment exit, etc. So that's what I said earlier. Forbearance works. It does its job. I mean, that's why there is forbearance. So that's exactly what people want to see, and it works. So forbearance has positive effect in terms of real outcomes during the crisis. Okay? Now, it's a little bit, it's very tricky to interpret economic magnitudes here because as you know, forbearance is sort of a constructed variable, that's a residual, it's aggregated, it has no unit, it's a little bit problematic. But what we can say is that one standard deviation higher regulatory forbearance results in about 4.8 percentage points lower rate of exits in law restructuring. Okay. I think that compares to similar results, say, in Schroeder of Reich or whatever. So it's quite similar. So in other words, again, forbearance works in the crisis. Now, before I show you the results on what forbearance does in the long run, there's one sort of intermediate step that I would like to take you through. And that is, well, we argue that forbearance results in these weaker surviving banks, right? Which then don't allocate credit as well, right? So we can test that. So is it the case that forbearance now in the crisis results in weaker banks 5 years down the road? Okay. Now, for our mechanism to be what we think it is, this should be the case. And so we look at this, we look at highly forbearing MSAs and look at the quality of the banks that are in this MSA 5 years down the road. And indeed, we find that if you are more forbearing during the crisis 5 years down the road, these banks in your MSA have less equity, more non-performing assets, and a lower return on assets. So indeed, it is the case that if you're more forbearing now, you keep these banks alive, you have worse banks. Not very surprising, but you have worse banks down the road. But this is obviously supportive of our mechanism of how this actually works. So now I come to the sort of the bottom line results here. So we're looking at the long run effect. So the outcome variable is after 2011, all kinds of indicators. I've mentioned many of them: establishment firm entry rate, job creation rate, reallocation rate, employment growth. It doesn't matter really because the results are completely consistent. So it's not, pick your favorite indicator. And we regress that on in-crisis instrumented forbearance. Okay? And again, it's a big table, lots of indicators. All the coefficients, as you can see, are negative, and all the coefficients are significant. So in other words, whatever indicator you look at, it is the case that the outcome, whatever it is, whether it's entry of firms, entry of new plans, job creation in new firms, reallocation rate, so the sum of people that are laid off and added new, so how many people move to presumably better jobs, employment growth, wage growth, patent growth, and GDP per capita. So take GDP per capita, so the overall, the outcome of this. All of it is significantly negatively related to how forbearing you were in the financial crisis. Okay, so that's sort of the core takeaway here. And again, economic magnitudes. So what we can say is that one standard deviation in regulatory forbearance during the crisis resulted in 0.8% of the standard deviation lower MSA level per capita GDP growth after the crisis. So it's significant, economically significant. I will give you a little bit different way of looking at the economic significance in a second when I look at the trade-off. So how many jobs do you lose relative to how many jobs do you gain, right? I mean, you want to see that actually it's more that you gain, because otherwise it would still be optimal to be forbearing. Right? Just because there's a little bit more jobs, there's more jobs, it doesn't mean that it's not optimal to be forbearing. Okay. So I will not talk about 6 more things. I will probably talk about fewer than 6 more things. Let me see how far I get. There's a number of things that I really want to talk about and a number of things I don't have to talk about. So let me pick and choose a little bit. There's 6 topics, all related to robustness and extensions. Now, the first is instead of using our very fancy measure of forbearance, which is very constructed, instrumented, and sort of moves way far away from sort of something tangible, we just use as an alternative the share of bank assets that were restructured in an MSA, without instrumenting, without anything, just how much of bank assets was restructured. brute force type of variable. And if we do that, we get very similar results. Okay, so the coefficients all have the opposite sign, so it's right, forbearance and the share of assets restructured have negatively correlated. So we get very consistent results. So the tougher you were, the more you restructured in the crisis, the better your outcomes later. Also based on this variable, which is not instrumented, which is not a residual, which is not, it's much simpler approach. Okay, good news. I will skip the OLS part. The OLS don't come out. Let me just say that. So if we don't instrument for the forbearance, it doesn't come out. We have a very long discussion of that in the paper. If you're interested, it's very technical. I think it makes sense, but I don't think it's important. I think the third point is more interesting. So this trade-off. So, I mean, you lose something in the crisis, you gain something later, but is it a positive net effect or not? So is the gain actually bigger than the pain? And so what we do is we regress the jobs lost during the crisis on the jobs created afterwards, for example, or the firms disappearing during the crisis on the firms appearing after the crisis. And let me emphasize here one thing. Here, we're clearly estimating the benefits. Why? Because the benefits may accrue well into the future. I mean, we are cutting things off in 2015 because that's when our sample ends, but they may be going on forever or at least for a long time. So please keep that in mind. Now, if we do that and just focus on this two-stage least square results here, we get positive and significant coefficients on the crisis loss when we regress on the post-crisis gain. But that's not very surprising. What's interesting is, and what we want to know here is the coefficients bigger than 1? If it's 1, you would just lose as many jobs as you gain later. If it's bigger than 1, you would gain more jobs than you lose now. And it turns out it's bigger than 1 in each case. So the way to interpret that is you gain 4.3 more establishments by being tough in the crisis than you lose. You gain a lot more firms. For each firm you lose, you gain 1.23 firms, a quarter firm, so to speak. And similarly, for job creation, for each job lost during the crisis because you were tougher, you gain 1.05 jobs after the crisis. Okay, 5% more jobs. The fourth point, I will talk about 4 and 5, I think, and then I'm going to finish, so I think I'll be okay. Nonlinear effects. Now, there's something highly implausible, at least for many people. There's something highly implausible about what we are saying, because it sort of suggests that the tougher you are, the better. I mean, close down everything. Why don't we close down banks now? I mean, let's get rid of them and then we have it's great. I mean, that can't be true. I mean, that it can't be true that in an MSA you close all the banks and that's good. At least I don't think so. So what we're trying to get at here in this section is there sort of an optimal level of toughness? I mean, you want to be tough, but not too tough. So in econometric terms, we check for nonlinear effects. What we get is very nice. I really like, I have to say, I'm quite fond of this picture because it makes so much sense. It's not, we do not find that just be as tough as you can. But, so we've classified here the toughness in terciles, so we have to do something. So we just look at low, medium, and high toughness. And we find indeed that only in the middle group you get these big positive effects. So if you're either too forbearing or too tough, you don't get this. Okay? So there's I don't want to say this is the optimal level of forbearance, but I just want to say there is an optimal level of forbearance. And we get that across essentially all the outcome variables. Now things become a little less significant down here. we look at wage growth and patent growth, but ultimately we get sort of, yes, you want to be tough, but not too tough. There's sort of a middle level of optimal, if you want, an optimal level of toughness in terms of future productivity growth. Now, the last point before I conclude relates to this literature that I told you about that argues over the effects of TARP. So is TARP good or bad for productivity growth, and did it get rid of zombie banks and zombie firms or not, or whatever? And our setup permits a very nice test of that, because all we really have to do is replace our variable forbearance with a variable TARP. And how much in that state, we only have observed at the state level, how many banks in that state were actually beneficiary of TARP. It's very nice, so we can look at both in the crisis effect of TARP and the subsequent productivity effects of TARP. And when we do that, we find, so this is in the crisis, we find that regulatory forbearance and TARP, in terms of these output variables, have similar effects. So recapitalizing banks also reduces the real costs of the crisis in the crisis. Now, I find that, again, plausible. So these coefficients look very similar to the ones that we get when we put forbearance in this regression. But when we look at the long-run effects, we also get the same effects as forbearance. In other words, if you forcibly recapitalize banks in the crisis, you do not get the benefits in terms of higher productivity growth subsequently, right? So all these coefficients are negative. So in other words, the more you recapitalize, the worse the real sector outcomes are 5 years down the road. And presumably that is because you didn't force banks to really restructure and realize their losses, because they got the equity, right? They got the equity, so they could continue the evergreening and lending to the firms. Essentially, not enough Darwinism took place, in a sense that not enough non-viable firms were cut off from credit because they were recapitalized. So I've always argued forced recapitalization is very good, because it keeps losses smaller in the crisis, because there's an externality to giving banks equity, and hence there's a government intervention that's justifiable. But in terms of the post-crisis outcome, the productivity, long-run productivity effects, it doesn't help. Okay, it doesn't work. And in that sense, I think we're making a nice addition to this recapitalization and does it eliminate zombie banks literature. I think we would say no. It doesn't eliminate zombie banks because it doesn't force banks to really realize their losses and stop the evergreen. Okay, I skip that. Let me conclude, and I'm pretty much on time. So resolving banks' impaired assets can reduce the problem of zombie lending. And keeping them alive, keeping these zombie banks alive is bad, because essentially it means that you reduce long-term productivity growth down the road. Now, unlike what Bruno says, I mean, there was a long discussion in the US on why the recovery was so weak in the US, etc., and it took so long relative to other recessions. Perhaps it had something to do with that. A lot of banks were essentially forcibly recapitalized and not resolved. Now, there was also a lot of banks that were restructured and resolved, but perhaps this has something to do with that. This is also a little bit a comment against the background of this big debate that you may be familiar with, is on why there is this slowdown in productivity growth all around the world. Now, the slowdown in productivity growth admittedly has started before the financial crisis. So the financial crisis can't be the only reason, but it could be there is at least partially there is an explanation here that because lots of countries, and the US was not the biggest sinner in that regard at all, lots of countries just saved their banks without forcing them to do anything. And that clearly, if you take our paper seriously, would result in lower long-run productivity growth. So maybe this is part of the explanation for that, because it's a big puzzle, right? Given the technological advances, etc. So it's one of the sort of the fundamental puzzles. There are many other explanations floating around, but this could be one. Now, the nice thing about the paper is sort of this short-run, long-run thing, I think. I think that's very important. Clearly, crisis intervention tools have a short-run and a long-run effect, that's not considered right now. I mean, at least when I'm involved in these types of policy discussions, nobody talks about that. I mean, if anything, they talk about minimizing the real effects during the crisis, and that makes sense, but I think there is another aspect, and this aspect may be important, so maybe we should consider that more. The problem with considering that more is that the political economy is extremely unfavorable. I mean, no politician wants to sacrifice short-run gain for some sort of uncertain long-run thing in productivity that nobody votes for him then. I mean, that's not, it's very, very difficult. So in that sense, maybe there is a case to remove it from the politicians and to make rules-based approaches here, tie the policymakers' hands, blah, so this whole discussion that we've had in many other contexts as well. I think that that is useful. Thank you very much.